Hello, I'm here with Professor Cresson's portfolio theory class, and today I'll be testing my own investment strategy. The strategy that I've chosen is to invest in companies with an ROE above 20% but an equity multiplier below 2, suggesting the highest levels of asset efficiency. I have 10 companies that have accomplished this over each of the past 5 years. And I have 10 companies that have not accomplished this over the past 5 years. And the 10 companies I have up here, I'll zoom in so you can kind of look at their ROEs and their equity multipliers. Here we have, I have Apple, Microsoft, Johnson & Johnson, Intel. You can see all of their ROEs above the north of 20%, equity multipliers usually in the range of 1.5 to 1.8. Nike, Taiwan Semiconductor, Telecom Argentina, Monster Beverage, Omegaflex, and Bed Bath & Beyond. And then below, the 10 companies that did not meet this criteria, I have Boeing, Chevron, Cisco, Coca-Cola, Disney, General Electric, Home Depot, IBM, Pfizer, Walmart. So it's two groups of pretty blue chip stocks. 5 of my first portfolio, which I'll call portfolio. The companies that fit the criteria I'll call portfolio A, and the companies that didn't fit the criteria I'll call portfolio B. But all 10 of portfolio B are a part of the Dow, and 5 out of the 10 of portfolio A are on the Dow. So all the companies are up over the past 5 years in terms of stock price. Okay, so what I've done is I have gotten my my monthly stock prices for each. This is portfolio A right here, and I have my monthly stock prices from May 1st of 2015 all the way back to May 3rd of 2010. Over here, I have the percentage changes, the monthly percentage changes over this period. And then down here at the bottom, let me get zoomed in so you can see it. I have the annualized return, the annualized variance, and the annualized standard deviation of each of the 10 stocks over the period, so I can kind of get an idea of how risky they are. For example, Apple's annualized return 28.253% with an annualized standard deviation of 24.085%. That's a pretty high standard deviation, but they're posting up some of the best returns out of any of these companies. And then all the way to the far right over here, highlighted, I have portfolio A's return of annualized return of 20.541% over the period, and annualized standard deviation of 13.213%. So that doesn't really mean much until you compare it to something. So in my other sheet, I've done the same exact thing for the portfolio B, the companies that didn't fit the criteria, and their annualized return over the period was 14.545%. And their annualized standard deviation was 12.543%. So portfolio A, the companies that did fit the criteria, had about a 6 to 7% higher annualized return over the period with a less than 1% higher standard deviation. So 6 to 7% more return with less than 1% more risk. I would take portfolio A over portfolio B, and I think most rational investors would as well. And also, on the left right here, we have the annualized return and annualized standard deviations of the S&P 500, the S&P 500 on the left and the Dow on the right. S&P 500 was 14.013%, and the Dow was 12.207%. They did have slightly lower standard deviations than Portfolio A, but they had significantly higher return of 6 to 8% more than the market. So you're always going to expect the market to have a little less standard deviation than your stocks as a whole. So just looking straight at the numbers, it looks like Portfolio A has outperformed Portfolio B, as well as the market as a whole. And I would contend that this is because of the way these companies are managed and their high levels of asset efficiency. In this sheet, this is where I've run my statistical analysis to test for statistical differences between Portfolio A and Portfolio B, as well as the two portfolios against the market. So over here, I'm trying to get zoomed in just so you can see it all. Right here, I've run my t-test, assuming a two-sample t-test, assuming unequal variances of my top portfolio versus my not top portfolio, so A versus B. And what this tells me, the t-stat is less than the t critical two-tail value, so there is not a statistical significant difference between the two, at least using the t-test. But I would still argue that A is far superior to B, no matter what the t-test says. And also, next I ran a regression of my Portfolio A, my top companies versus the Dow. And what I found is that their beta, their slope, is 0.8329, so they're actually less risky compared to the market as a whole. And also the correlation coefficient was 0.716, so they're roughly 71% correlated with the Dow 30. Portfolio A is, and that sounds very high, but I just want you to keep that number in mind for something we're going to see in a minute. Okay, next I did my top companies versus the S&P 500. The numbers were about the same. No statistical significant difference between my top portfolio and the S&P 500. I found that looking at the comparison of the t-stat versus the critical t-value. And also roughly the same beta, less than 0.8, so a little bit less than versus the Dow, and a correlation coefficient of 0.72, so roughly 72% correlated with the S&P 500. So nothing too new there. And then this is my final t-test. It's my Portfolio B, the companies that didn't fit the criteria versus the S&P 500. And again, no statistical difference between the two. Actually, the t-stat is so low, suggesting they were roughly the same over the period, and their returns were very, very close to each other. They both had returns of 14% and about the same standard deviations. And then next, this is where the most important comparative info comes from, and it's the regression of my Portfolio B versus the Dow, and my regression of the Portfolio B versus the S&P 500. And what I found is that the beta versus the Dow was 1.035, so it is more volatile than the market. Portfolio B is. The companies that didn't fit the criteria were more volatile than the market. They're a little bit less volatile than the S&P 500, but still more volatile relative to the S&P 500 than Portfolio A was. And the correlation coefficient between my not top 10 companies and the markets versus the Dow was 0.93. So it's 94% correlated with the Dow 30 and 92% correlated with the S&P 500. And if you'll remember before, I'll scroll back up to it, my top company's correlation coefficient versus the Dow was 0.71. So almost a 20% higher correlation with the market, and really almost as close to 1 as you can get. And what this really shows you is that my portfolio B is just strictly being driven by the market, just being strictly driven by the market. The correlation coefficient is almost 1. But portfolio A is only 70% correlated over the period, but it's